If you're not familiar with BlackRock, it's time to take note. Established in 1988, this American multinational investment management corporation has climbed to towering heights. BlackRock is the largest money manager in the world, having a staggering $9.57 trillion of asset under management. That's more than the gross domestic product of every country in the world except for the US and China. BlackRock's influence goes beyond its financial prowess. It's a hub of key individuals who have served in high-ranking government positions before joining the firm. This includes Brian Deese, who was a senior advisor to President Barack Obama, and Adewale Adeyemo, Obama's senior international economics advisor. Richard Pyle, BlackRock's global chief investment strategist, served in Obama's administration, and Thomas Donilon, chairman of BlackRock's research arm, was Obama's national security advisor. Moreover, the firm has been proactive in hiring former policymakers like Dalia Blas, a long-serving SEC official, who now heads BlackRock's global public policy group and social impact teams. Others like Corianne Stephenson, a former Federal Reserve official, have also added to the firm's influential presence. As you now understand, BlackRock has an immense impact on both political and the world markets. So how does BlackRock's considerable size influence market dynamics? How does their significant investment in technology influence global markets? How does their stewardship role shape corporate governance and policies? Lastly, how does their extensive stock ownership affect market competition? BlackRock's scale is indeed colossal. Its valuation has skyrocketed since its IPO, resulting in a 4,472% return, crushing the S&P 500. Today, BlackRock has a market cap of $103.7 billion. First, it's important to grasp the sheer magnitude of BlackRock's influence. Its size means it holds a significant percentage of shares in many major corporations worldwide. In the US, it holds at least 5% of most companies on the S&P 500. This ownership gives BlackRock considerable sway in voting on corporate decisions and the power to influence the direction of these companies. Secondly, the investments BlackRock makes can create waves throughout the financial ecosystem. When such a large entity moves its money, it can directly affect stock prices. In his 2020 annual letter to CEOs, BlackRock CEO Larry Fink stated that his company would place sustainability at the center of their investment approach. This was a major signal to the market, given BlackRock's significant size and influence. As a result, there was a notable uptick in interest in ESG investments across the market. According to Morningstar, the inflow of funds into sustainable investments in the US more than doubled in 2020. This was not solely due to BlackRock's decision, of course, but their stance likely influenced other investors to follow suit, considering their role as a market leader. Moreover, BlackRock's buying and selling decisions can impact market liquidity. That's the ease with which assets can be bought or sold without causing drastic price changes. Their significant purchases or sales of stocks can impact the liquidity of those stocks, influencing their price volatility. But BlackRock's influence doesn't stop there. Their vast size allows them to be a market maker, a role usually reserved for large financial institutions. As a market maker, BlackRock can provide liquidity and depth to the market, reducing price volatility and helping the market function smoothly. BlackRock's size and the scope of their investments can affect everything from individual stock prices to sector evaluations and overlap market stability. They have the unique ability to not just participate in the market, but to shape it. And that's a powerful position to be in. It's no secret that technology is a key driver in today's investment world. But at BlackRock, they've taken this to a whole new level. One of the secret weapons in BlackRock's arsenal is their proprietary technology platform, Aladdin, standing for Asset, Liability, Debt, and Derivative Investment Network. Aladdin is more than just a catchy acronym. It's an end-to-end investment management and operations platform that provides risk analytics, portfolio management, trading, compliance, operations and reporting, and performance and attribution. So, how does Aladdin contribute to BlackRock's market influence? Aladdin provides BlackRock with superior data analysis capabilities. In the world of finance, data is king. and the ability to analyze and interpret vast amounts of data gives BlackRock an edge. It allows them to spot trends and risks that others may miss, enabling them to make informed decisions swiftly. This might involve identifying a promising sector to invest in, or spotting a potential risk and mitigating it before it becomes a problem. Aladdin's advanced risk analytics tools enable BlackRock to manage risk across their portfolios proactively. This means they're not just reacting to market shifts, but anticipating them. They can evaluate potential impacts of various market scenarios on their investments, helping them safeguard their assets and maintain stability, which in turn fosters confidence among other market players. BlackRock isn't just using Aladdin for their own benefit. They're also licensing the technology to other financial institutions. This means that many investment decisions made around the globe are being influenced by BlackRock's technology. In this way, BlackRock is not only a participant in the market, but also a driving force shaping how the market operates. In essence, BlackRock's investment in technology equips them with superior foresight and risk management capabilities. Their technology impacts their market influence by allowing them to make data-driven decisions, manage risk effectively, and shape the market dynamics by providing tools used by other market participants. This technological edge is a key aspect of BlackRock's wide-ranging influence on global stock markets. Stewardship is a powerful tool that large institutional investors like BlackRock wield. They hold positions in many companies worldwide, giving them a voice in the strategic direction these companies take. But how does BlackRock's stewardship role influence corporate governance and policies? First, let's explain what stewardship entails. As shareholders, BlackRock has the right to vote on certain issues at companies' annual general meetings. These votes can guide decisions on a range of matters, from electing board directors to approving mergers and acquisitions, to voting on shareholder proposals about environmental, social, and governance known as ESG issues. BlackRock takes its stewardship role seriously. With their vast shareholdings, they have the power to influence the outcomes of these votes, steering the companies in certain directions. Let's consider the earlier example of BlackRock's commitment to sustainable investments. BlackRock's focus on sustainability doesn't stop at its own investment decisions, it extends to its voting practices as well. In recent years, BlackRock has used its voting power to support shareholder proposals aimed at improving companies' environmental impact disclosures, reducing carbon emissions, and enhancing diversity in leadership roles, to name a few. In 2020, BlackRock, for the first time, voted against the re-election of two Exxon's board members. This decision was based on concerns that the company was not making sufficient progress on addressing climate-related risks. BlackRock's move was seen as an indication of its growing willingness to exert its influence over companies on environmental issues. This move sent a clear signal to the market. It indicated BlackRock's firm stance on the need for companies to take climate-related risks seriously, and it highlighted their willingness to use their voting power to hold companies accountable for their environmental impact. When BlackRock votes for these ESG initiatives, it not only helps these proposals pass, but it also sends a signal to other companies and investors about the importance of these issues, impacting the whole market. BlackRock's extensive ownership of stocks plays a significant role in shaping market competition. Given its sizable holdings across numerous sectors, BlackRock's position can influence competition in several ways. Firstly, BlackRock's extensive ownership of stocks across different companies in the same industry can lead to a phenomenon known as common ownership. Common ownership refers to the situation where a large institutional investor, like BlackRock, holds significant stakes in competing firms within an industry. Some academic studies have suggested that this could soften competition between these firms, as they share a common set of significant shareholders. For example, consider an industry where BlackRock holds substantial stakes in most of the major players. This ownership structure might discourage aggressive competition between these firms, potentially leading to higher prices for consumers. However, it's important to note that this is a contentious issue in financial economics, and the evidence is not conclusive. Some argue that institutional investors like BlackRock merely invest passively and do not influence management decisions that could soften competition. Secondly, BlackRock's broad ownership provides it with a comprehensive view of the market. It can spot trends, risks, and opportunities across different sectors and industries. which could give it a competitive edge in making investment decisions. Finally, BlackRock's scale allows it to influence market rules and regulations. Their extensive ownership of stocks and the influence it wields could shape the discussions around market policies, regulations, and standards. After the financial crisis in 2008, there were extensive discussions about reforming money market funds, which were seen as a source of systemic risk. BlackRock, as a significant provider of these funds, was actively involved in these discussions. The firm proposed a specific model of reform known as the standby liquidity fee, which would allow funds to charge a fee if investors wanted to withdraw money during times of stress. BlackRock's proposal shaped the conversation and eventually influenced the final rules issued by the Securities and Exchange Commission, SEC, in 2014. While the SEC didn't adopt BlackRock's proposal exactly, they introduced similar mechanisms like liquidity fees and redemption gates into the new rules. This example demonstrates how BlackRock's scale and influence allow them to be actively involved in shaping financial regulations, highlighting the firm's significant impact on the regulatory landscape of the stock market. So, the question is no longer whether BlackRock is influential. That's a given. The more pertinent question is, how do we as investors, companies, policymakers, and stakeholders navigate this influence? And how do we ensure that this influence leads to a more stable, sustainable, and inclusive financial ecosystem? This is a complex and evolving landscape, one that demands our continued attention and engagement. As we move forward, let's continue to ask hard questions, push for transparency, and foster dialogue. Because ultimately, the story of BlackRock's influence on the global stock market is not just about one financial behemoth. It's about the future of our financial system. I hope you liked this video. If you want to see more like it, remember to subscribe. Until next time.